Bismillahirrahmanirrahim. Welcome to my channel Finance and Tax Hub. This is your host Arsalan Abbasi. By profession, I am a qualified chartered accountant. Today we are going to start an accounting series, and this is the first video of the accounting series. In this video, we are going to discuss the fundamental principle of accounting. This basic fundamental accounting principle is the part of the course syllabus or the fundamental accounting of any commerce related studies like ICOM, BCom, ACCA, CA, whatever. What is the fundamental principle of accounting? Before knowing what are the fundamental principles of accounting, we need to learn the objective of the accounting. The objective of the accounting. The objective of the accounting is to prepare and present consistent, reliable, and comparable financial statement for the user of the financial statement on the basis of this sort of financial statement they can take the right decision. To ensure that the financial statement or the books of accounting records contain these qualities, the accounting board has established certain principles. What are those principles? That principles are called fundamental principles of accounting, which are used all around the world by the accountant while preparing its books of account. And any new rules and regulations are prepared on the basis of these fundamental principles. Since these are accepted all over the world by the accountant and used by the accountant, that is why they are called generally accepted accounting principle, which is also called GAAP. So let's discuss each principle one by one. The first and the very important principle which form the base of the accounting is the separate entity concept. Separate entity concept principle state that business activities separate and distinct from owner and all other business economic activities. It means there is a wall between owner and the business. What is the implication of this principle? The implication is that the accountant will be only responsible for recording and bookkeeping of the business and not for the owner. For example, if Mr. A is the owner and he is running a business of shop and he purchased a furniture costing $50 for his house. So it means this furniture is purchased for house, it should not be recorded in the books of account. But when similarly Mr. A also purchased furniture for shop for $20, since it is purchased for the shop, for the business, so it must be recorded in the books of account. So this principle states that owner and the business should be separate. Not only this principle states that the owner and the business is separate, But it's also stated that the business and another business is also separate. If you are buying some furniture for the shop, you will record in this books of account. But if you are buying furniture for petrol pump, you will record this furniture in the books of account of petrol pump. Here one thing is important to note that this separate distinction between business and the owner is only for accounting purpose and not for any legal purpose, because legally the owner and the business are same, except in case of company, which hold the position of separate artificial person and can enter into a contract with another person or another company at its own capacity. So next principle of accounting is the money measurement concept. The money measurement concept states that only those business transactions can be recorded which can be expressed in terms of money. Means you will record only those transactions which you can measure in terms of money in your books of account. For example, you have purchased furniture which you know holding the value of $50. So you will record it because it holds the value. But similarly, a finance director of any company, no matter how much experience he is, shall not be counted and recorded in books of account, because it cannot be measured, because the value of finance director cannot be measured in terms of money, so it should not be recorded. So the next principle accounting concept is dual aspect concept. Dual aspect concept state that every business transaction has two aspects. It is very important principle, and in fact it is the base of the accounting. There is two leg of every business transaction. There is two leg of every business transaction. One is called debit and another is called credit. At the end of the year, all the debit transactions must be equal to credit transactions. If they are not equal to credit transaction, then there must be some mistake, or either you have recorded one leg of the transaction and missed the another leg of transaction to be recorded in the system. This also works as a control factor. This principle is also expressed in terms of an accounting equation, which is equity asset is equal to the asset of the business is equal to equity plus liabilities. Means asset of any company either financed by the equity or liability. We have a separate lecture recorded on this accounting equation. For example, you are running a general store and you made some sale. A sale is a business transaction. So what is the two aspect of that sale? One aspect is sales will be credited, and cash or bank, if you have received through bank, it will be debited. So in the end of the year, the both will be equal. So why sales credit and why cash debit, and what is credit and what is debit, this we will learn in our future videos. So this is the dual aspect concept. So our next accounting principle is the going concern concept. The going concern concept is basically an assumption which states that business will continue to operate for unforeseeable future. Business will start from here, and with a little bit of fluctuation it will continue to operate for the unforeseeable future. There is no foreseeable end to the business here or here. There is no foreseeable end to the business. This is very important assumption. It means there is neither an intention of the owners nor any compulsion to close the business in the foreseeable future. We always assume the going concern assumption as valid, and that's why we are measuring the assets on cost rather than force sales value, because we believe that we are going to take benefit from the cost of the asset throughout the life of the asset, and we are not going to sell it forcefully. Because we are following these assumptions, going concern assumption, this leads towards another basic concept, which is historical cost principle concept, which states that the business transaction shall be initially entered into the books of account on historical cost basis. Here the word initially is very important. This principle limit the entry to the books of account on historical cost basis. Subsequently, the asset can be measured on revaluation basis or market value, but at initial recognition it must be measured at cost, means the actual consideration, for example cash or any other value or any other asset paid or given up to acquire the asset. For example, a business has purchased a land for rupees $5 million. The fair value of the land at the time of initial recognition is $7 million. The company will record the land at 5 million rather than at 7 million. Record the land initially at 5 million, but subsequently if they are following revaluation model, they will subsequently book a revaluation surplus and record it and increase to $7 million. So this is the historical concept which states every transaction to be recorded at cost. So our next accounting concept is time period principle. Time period principle states that the economic life of an entity to be subdivided into artificial periods. Subdivided into artificial periods. As going concern principles state that the business has no end. Since business has no end, we are assuming that business has no end and it will be continue for unforeseeable future. So the owner of the business cannot sit and wait and let the business run. You must need to break the accounting period into small artificial period. It could be year, and it could be year, it could be month, it could be quarter. So they will break the life into period, and then for this period they will analyze the profitability on period to period basis by summarizing, analyzing all the business transaction for that period. Since the life of the period is subdivided into period, an owner has to measure the profitability of each period. Profitability of each period. It is only possible if you record the income and expense of that period properly. Here is the need for another accounting principle, which is called matching concept principle, which state that all the expenses should be recorded in the period in which related income for which those expenses are incurred are recorded. It means in business there is a term, sometimes you are making sales on credit. No matter you make sales credit, but this sale is for this period, so you record the sales no matter when you receive money or cash. For example, the year end of the business is June 30. You have made sales of $300 and received cash and recorded the sales, but you have to pay the commission on that sales at the rate of 10% to the agent, which is $30, but you have not yet paid in this period, and you paid it on August 27. Even if you paid it on August 27, you have to record the liability here in this period to match the income and expense, and to correctly calculate and estimate the profitability of the business. Thank you. If you have any queries, suggestion, do comment and subscribe my channel and like and share my video.